Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day. Ira Epstein of Linn Associates with your financial market update for this wild Valentine's Day, February 14th, 2018. And right now we're at about 3:20 p.m. Central Standard Time. And these will be the settlement prices that we get in the stock indices. And I realize so many of you are going to say, how could it be? We get all these inflation readings, you drop down, you come back 600 points off the lows in the Dow, you come off, nearly 70 points in the S&P, 140 points, 135 points in the NASDAQ, and 50 in the Russell. And you got the inflation. Why isn't the market falling apart? You've got the bonds and the notes both near their lows, blah, blah, blah. Folks, you don't need a reason every time for a market to make a move. That's really the only right answer. Markets move. And maybe the market had anticipated this. It doesn't matter. You've got so many signals here. Number one, the stock market being up says that the markets, at least the stock indices, traders that are trading them aren't that overly concerned that inflation is here and it's going to hurt the marketplace in a bad way. You have the opposite going on in the metal markets, which are saying, yes, inflation is here, but this is what we needed. Here's our steroids. We're ready to move on it. The dollar down hard and the currencies up as the market, at least the world markets that trade currencies, are saying, nah, nah, nah. U.S. interest rates higher, economy slows down, not good for the dollar. You can see even the energies were up on the news. So if we could, let's take a look together at the S&P 500 index. You can see how it fell from 2874.50 on a weekly closing basis. Last week you got down to 2619, and now you're 77 points off of that at 2696.5, putting the market what? Back into an area where support was found against that 18-week moving average of closes. As we come to the S&P 500 index by itself, I'm going to be on some of the other charts that follow this. I'm going to use this area and cover this, not for any reason other than I want you to be able to see this as it's on the chart. And as I start putting on some of the studies, it gets sloppy if I don't do that. You can see how you came down, made a low, back up, so on and so forth. But when you put the swing line on, you get to see a better story. You've got the story now of higher lows and higher highs. What you don't want to see happen is you don't want to see today's lows taken out in the next two trading sessions, specifically Thursday or Friday. If that happened, the signal would be one of a bull trap, and the market might head down to the closest of a major moving average if it's under the market or the Bollinger Band. Let's put on some of the moving averages. If it got underneath this low, it'd be under both the 100-day and the 18-day average of closes. So that wouldn't be a target. What else do we see? We see that if you look at this, other than this one day here, every day practically you've been hitting the 100-day averages. The market is now in a reactionary move after it got up to this high, way up here, coming back now, maybe making a run for the 18-day average. I don't know. Even if it does, the bias is still down on the market. So while the swing line is up, and that's the short-term trend without question, it's countered by the fact that the market's under the 18-day average. So what could be setting up is a trading pattern between the 100-day average and, if it can reach that number, that resistance. Take out this low and a different event happens, and you might head back for the lower Bollinger Band. So as a technician, chart technician, that's how I'd be analyzing that part of the market. In terms of momentum, the market had gotten oversold back here, and it's been correcting that with gradual lifting of momentum to the upside. You can see the red line right here is over the blue, pointing higher. Not markedly higher, but pointing higher. So we have a market that grabbed some traction. As it turns out, when it got down to this 25-30 level, that number, where it came from, doesn't matter to me. It was under the Bollinger Band. The market moved back over it, and suddenly the 100-day average became fairly important. In the NASDAQ, same thing. You first break out, you got underneath the lower Bollinger Band, made a deeper move, and with today's action, you change all that, because now you can argue until today's low is taken out, you have a pattern of higher lows and higher highs. I can live with that. Resistance at the 18-day average of closes. If the market closes over that, you'd have to ask yourself, would you want to be a buyer over 67, let's call it 50, and put stops under today's lows of 64.56? That's a pretty big risk, so I don't know that you're going to attract people to that or not, but at least I have a resistance area in place. In the Dow, same story. Now I got an argument of 3 higher lows, higher highs. If the market wants to rally further, a potential resistance is the 25,419 level, the 18-day average of closes. Momentum is pointing higher. The 100-day average was a pivot number, if you will. It was going back and forth over it. But over the past 3 days, it hasn't even hit it. It's been moving back to the upside. In the Russell, we have a different world. Number one, the 100-day average is above the market, and you're making a run for it right now. And if you take a look today, you hit it. You got to 1524.70. That number is 1524.25. Excuse me. So the first resistance we know. If it goes further, it might hit the secondary. Is the market in a bullish setup? No. But momentum is up. The swing line's up, but you're still under the key 18-day average of closes. In the VIX, as I told you, when you got up here, that was probably a blowout number. Look at how the market fell back, and you tell me where it stopped today. That 18-day average of closes. Doesn't mean that it has to just stop right here. Further supports down here at the 1199 level. We're going to knock on the door when we reopen of being oversold in the market. I wouldn't be surprised to see the market make a stand against that for a little bit here, but the trend is down as measured by the swing line. You closed under the 18-day average of closes. That's bearish, and you can see the market coming down. What was interesting is you didn't get all the volatility in this market on expiration day. You got it today as far as I'm concerned. I'm talking the options on the VIX. In TLT, you're continuing on this well-entrenched bear trend with an embedded reading. What does embedded mean? I get that question. Embedded simply means that the slow stochastic study, which is a momentum oscillator, and no, I do not know the definition of stochastics. People seem to make up these names and words, and I knew George, and I have no idea. I used to ask him what it means. He'd laugh. But he was a mathematician. I'm not. And to make a long story short, it's a momentum oscillator. There's a fast stochastic, there's a stochastic, and a slow stochastic. I like the slow one. I think it fits my style of analysis better, that's all. And when I look at this, when both numbers get under 20, and I came up with this many years ago, as I became a student, I studied MACD, relative strength indices, Williams Relative Strength Index. I used to know Mr. Williams. I mean, I had TV shows where if you named from Bob Prechter to John Bollinger, I had all these men on my show, and I promise you, off camera, I was learning and asking questions, and I had the ability to get it all done. The great Joe Grandel, the showman, I mean, all these guys. On balance volume was his indicator. So as you look at all this, and I came up with the fact that when both numbers get under 80, something's got to happen. It's the same thing when they get rather over 80 or under 20. And I came up with the idea they're locking in, and a better name is a locked-in stochastic, yeah, or an embedded. It seems to lock itself in, another word. Could have been either one. But that means the momentum has locked in until that red line gets back over 20. And that's what you're dealing with, and you tell me. The other part, when you're under the 18-day average, I teach in my charting course, and it doesn't mean I'm right, by the way. I'm never teaching you to go long under that number. Yes, I'm teaching you to come out of shorts under that number in a specific way, but why am I looking to ever fight the trend? And if you believe, as I do, that this is the line in the sand, and it helps filter out when trends don't happen, or when they actually do happen, they keep you straight in fighting, not getting long against it. I can only tell you, early in my career, I was one of these guys that would say, oh, it can't keep going down. It can't keep going down. It keeps going down. It keeps going down. Or it can't keep going up. It keeps going up. How many of you feel that way? You've seen it. And you're always, all of you, probably as a group, everybody's trying to understand the fundamentals. Why did the market do that? Every day doesn't need a reason. When I look at the bonds, lower highs, lower lows, embedded reading, next objective, if it can make it down there, the lower Bollinger Band. It's done a pretty good job so far. 10-year notes. Well, now the market's just plain oversold, and it's been oversold. If we go back to yesterday, both numbers were over 20, so that's not embedding. That's not embedding the day before. It's the first day they're both down there. Notice where the market's making a run to. You got down to 120.08.5. You tell me that lower Bollinger Band. And if you think people don't look at these numbers, shame on you. They do. And I am of the belief, those old Merrill Lynch commercials where you'd see the herd running down the street, I wanted to be with the herd, the guy with them that was running over those other people. And that's because traders look at these things. That's the concept. I want to be with the trend. In the dollar index, the market back under the 18-day average, but we're not trending. You've got a pattern of higher lows, higher highs, but you're back under the 18-day average, and momentum is pointing down. This is a confusing market. You don't have to make anything out of it. What happened today is the eurocurrency turned bullish. The market suddenly got back over this number. Now, look where it stopped yesterday, right at that 18-day average. You had the CPI number come out today. Market drops away on it. Everybody's getting, oh, the dollar's going to see higher interest rates. And then traders started rethinking it all. And they started coming up, and once it cleared yesterday's high, it just didn't look back. So that gives you now a pattern of higher lows and higher highs, which is bullish. The bulls will want to defend not having that number taken out over the next 2 trading sessions. My theory, just mine, is that if that number's taken out, prices often go to the next moving average if it's under the market, or the closest of a Bollinger Band. In this case, it'd be that number. It doesn't mean it has to get there. It's my theory. Theory doesn't mean it happens all the time. In the British pound, I can make an argument you're going back to the 18-day average to fight a battle. You were oversold. You're correcting the oversold condition. The swing line has turned up, but you're still under the 18-day average. So you got the pattern of higher lows, higher highs, but it's filtered and negated because you're under that 18-day average of closes. The Japanese yen must know something because it keeps getting bid up like this. It is overbought. It's getting extended now because it's 2 days over the upper Bollinger Band. But traders have been running to this market probably fearful that inflation is picking up in America, and they don't know what that means for the dollar. I think that's going to be the big argument that you hear shortly. On the CME Bitcoin, you still haven't grabbed any real open interest. You got 1,000 contracts, and you trade approximately 3/4 of that every day in the volume. And this market has gradually come up, making a run for the 18-day average, but it's not trending. You have a higher high, a lower low, and you're making a run for the 18-day average, which I'll call a resistance point. Is the market got anything more than that? I don't know. Momentum is still trying to work its way higher, so I'm looking for that as the resistance. Now, you double bottomed in the April crude oil at the 351 level. Both of these numbers are 351. There's no magic there, but I was asking people if they knew what it cost to ship a barrel of oil from the U.S. to Asia. And I'm still thinking at $1 1,000 miles or something in that area, that 350 is probably getting itself fairly close. I don't know. I don't even know the amount of nautical miles, but in looking at that, not one of you answered it, I'm guessing it's close to that number. If you take a look at the April Brent, the market's made a stand right here at the lower Bollinger Band and the 100-day average of closes. On the close, it looks as though, and I don't have the final settlement, you're going to lose the embedded reading. Now, you can gain it back tomorrow if you're lower. If you're not lower, the odds are going to favor price, might move back to that 18-day average of closes, but it is not a buy. It's still under that number. In the April WTI crude, you never did embed. You got oversold, and the market's doing its job. It tried to get to the 100-day average twice. Couldn't do it. it held the Bollinger Band instead, and you did have this whole session down. And remember what I told you. This is a very dangerous pattern because when the market moves to the right of the Bollinger Band, you don't know how far it's going to pop. Because of how it popped today, you got higher lows and higher highs. You're out of the downtrend, but you're not in an uptrend because you're under the 18-day average of closes. They filter each other. You didn't quite do that in gasoline. Gasoline still has the embedded reading. It still has the pattern of lower highs, lower lows. Has to get over 191.72 to negate that pattern. You only hit 190.70 and you kept the embedded reading. So this is still in the bear camp as far as I'm concerned, as is natural gas with its embedded reading and a clear pattern of lower highs, lower lows. You know, one of the things that we do and that I specifically do is I like to use a study for when a trend kicks in, where might it go? And I was a student of Gann, Fibonacci numbers. I can tell you all the stuff I've looked at. I tried to understand Elliott waves, but between all the counts and the mini counts, I got lost in it just as I did in Gann theory. And I tried so hard to understand those, and I finally gave up. I needed something simpler. One of the things that I came up with was at this firm, they developed a combination that uses so many of these theories that when a market gives you a certain setup, like from a low to a high to low, and then a kickback that doesn't take that out and goes down, you get a series of price counts to the downside or upside. Do they always work? Absolutely not. Does Gann always work? No. Does Fibonacci always work? No. Does relative strength always work? MACD? No. They work more times than not, probably. And for some people that have become masters in them, they can make the market look like it, but when they put the real money on the line, it gets to be a different story. What I happen to like about price counts is it's not a tool that triggers you to buy or sell. It's a tool that gives you an idea where a market might head once a pattern sets in. We explain it all in PDFs and the like. All you need to do is call us, go to our website. You can click up here, or underneath us it says click here on many websites, and we'll send you the PDFs, the videos, and if you want the software, make it free available for you to try out if you haven't done it, so that you can do these on your own. That is what it's about. In addition, we send out a chart of the day that covers a lot of this. So, I'm Ira Epstein. Hope you take advantage of it all. Go to our website to do so, and I'll see you tomorrow.